Hi, this is David Dickens, and today we are doing 3 different listener questions. Ted is wondering how he can manage the amount of money he's going to leave behind in inheritance for his kids. Richard thinks he's about to get laid off and is wondering if he should be happy or sad. And Roger is questioning whether he should have a trust set up to save his kids tax money whenever they inherit his accounts. I think we've got something in here for everybody. Hopefully you find something here just for you. I'll go get Walter, and we'll get started.
It's another edition of Cover Your Assets KC. I'm Walter Storholt alongside David Dickens. Based out of Overland Park, you can find Creative One Advisors Group online at coveryourassetskc.com. David is the president and wealth advisor there at Creative One Advisors Group. And we are always so excited to jump into the show each week with David and get his insights into the financial world. But there's just a little extra layer of excitement whenever we have one of these listener question episodes, because we get to cover a lot of ground in these and kind of get into the nitty and gritty of somebody's questions. So this should be fun. Before we dive into those questions that you teased a few moments ago, David, first, hello and welcome back to the show once again, and I hope you're doing well.
Thanks, I am doing well. I think one of my takeaways from last time we did this was I was heading out of town to go see some twins get born, grandchildren, and of course I didn't get to see them born, but I got to see them right after they were born, and everybody's doing great. The 3 boys that are now their siblings, they're doing great. Mom and Dad and everybody is just doing fantastic down in Texas. So that's been an exciting bunch of new stuff for us as we're getting ready to, as we're getting used to them having a family of 5 kids instead of 3.
Yeah, it's a big jump up, isn't it? A big change from 3 to 5.
It is a big jump up.
They were already outnumbered, and then it got a
behind.
lot worse.
Yeah, so that's been fun, and so it's as everybody always says when they become a grandparent. Boy, this grandparent gig is way better than the parent gig, and so I wholeheartedly agree with that.
Right when all the screaming and crying and yelling was happening, you got to say, "Okay, we'll see you again in a few weeks," and headed on back to Kansas.
Well, I do get scolded occasionally for getting the boys all worked up right before bedtime.
Ah, nice.
But it's what I do, Walter.
Yes. Hey, I'm an uncle and get to do the same thing. So whenever we go and visit, and hey, let's get fired up before bed. We go down to the basement, bunch of balls. We're kicking them around, throwing them, bouncing off of each other. Everybody's screaming and crying by the time it's all over, and it's like, oh, bedtime. Oh, how are we going to come down from this?
Exactly.
So that's good stuff. I'm glad to hear it was a great trip down, and that the birth of the twins went well and successfully. And I know you've just got that much more love in your life now. So that doesn't get any better than that.
It does not.
Well, let's get to these questions and see if we can make the day a little bit better for folks like Ted, Richard, and Roger, who have our 3 questions of the day. Ted will be up first, and Ted says, how can I determine, David, how much money I can leave behind to my kids without shortchanging my own retirement? A pretty classic retirement conundrum.
Well, it is, but I got to admit, as I was reading that question, I thought, Ted, I have very few clients that are worried about this. So I either have clients that have way more money than they're going to ever need, or I have some that are close to the line and they're more worried about running out of it for themselves than how much they might leave behind.
Oh, interesting. Okay.
So I got 2 ideas for you. Again, nothing that we say today is advice for you, Ted, or for either of the other 2 questions, not specific advice for you. But here are some thoughts for you. I think it's really important to have, if you have a really good plan, a really good retirement plan, that you update, I'm going to say 1 time a year, because frankly, things really don't change that much year to year, but they can more than that. So I'd say you have a really good plan that you update 1 time a year that is pretty detailed about your income, your inflation expectations, your expenses, and the percent of growth that you're going to get out of your retirement investments. Then what you're going to drive to is, the motto will tell you, well, based on all those inputs, here's how much we're pretty sure you're going to have at age, say, 100. And Ted, you're unlikely to live to 100. You might, but if you can have that particular amount of money that the model says you're going to have at age 100, then you're probably going to have more than that whenever you do leave us. Males, 65-year-old males in America have a life expectancy up to about 84. Women, 65, up to about 86. So if you know you're going to have money left at 100, then you should have a really high level of confidence as to how much in a range you're going to leave behind. But let's say, Ted, that you want more certainty than that. There's certainly another way you can do it. Without knowing you, I certainly wouldn't necessarily recommend this to you or not. But you could buy a whole life policy, a whole life insurance policy, not a term policy where the premium goes up every year. But what you're going to want, I think, if you want to be certain about how much you're going to leave behind, is a whole life policy where the death benefit to your heirs is going to be tax-free, and it's going to be, you'll know that amount to the penny because that's going to be the death benefit stated on your life policy. And it's going to have a fixed cost. So the cost won't go up each year as you get older. It's going to be steady. So let's say, Ted, that you're 65 right now. We don't know whether you're going to die at 75, 85, 95, or 105. But if you die at 105, the cost of this whole life policy will not have gone up, and the death benefit will be the same that you bargained for today when you bought it. So those are two ideas as to how you might go about getting more certainty as to how much you might leave behind. Really, your question was, how much can I spend in retirement without shortchanging my kids' inheritance? So that's, everybody's different on that amount they want to leave behind. But what I would encourage you to make sure you don't do is get so tied up. Everybody's family dynamics are different. You might have a special needs kid that you are really worried about. Most of my clients say, you know what? I got my kids through college. They are upstanding, employed, independent adults. They're on their own. I save this money for me and my spouse. And if there's some left behind, that's awesome. And that doesn't quite sound like your situation, Ted. So if you want to know for sure the minimum amount you're leaving behind, think about that whole life policy and get some good real advice before you enter that contract.
Really good question, Ted. Thanks for sending that one in to us. And I found your note interesting there at the beginning, David, that you actually don't have a lot of people in that specific situation. They're kind of one end of the spectrum or the other, not trying to kind of do a little bit of both. So a little bit of uniqueness there.
Yeah, our software has a box we can fill in that says, I don't ever want my retirement assets to go below this. We almost never fill in that box. The client never has a dollar amount that they say, oh, I never want it to go below this. So anyway, everybody's different. That's the exciting part about my job is everybody's different. And you're just trying to solve a puzzle for the person in front of you. And it's going to be a different puzzle for the next person on your calendar.
Okay, very good. Well, let's solve a puzzle for the next person on our list. But before that, if you have any questions for David or want to get in touch to ask maybe a question similar to what you're hearing on the show today, but want to talk about it one-on-one, you can do that by calling 913-317-1414 or go to coveryourassetskc.com. We've got contact info listed in the description of today's show as well. All right, so the next one on the list, David, is from Richard. And Richard says, I was planning to work for one more year and then retire. But I'm now hearing that we might have some layoffs, and I could be offered a severance package equal to 1 year's salary. So that seems like it would be great news since I was only going to work for another year. Am I dumb for hoping that I get laid off?
So, Richard, I had to read this question a couple times to make sure that I wasn't missing something. But I don't think you're dumb at all for hoping to get laid off.
It's a weird thing to wish for, but in this situation, kind of works out.
If they're going to pay you for not doing any work for the year that you were planning to work, I would say, generally speaking, that's a positive thing. You get to retire a year early on full pay. I got 3 different things that you'll want to think about if that actually becomes the case. One is your health insurance. Now, you may be already Medicare eligible. We don't know that answer here. But if you're under 65, then you might need COBRA. That's just the continuation of the insurance, health insurance you have at your company, and they have to offer that to you, and you have to pay, and sometimes it's a fairly big number every month. So, you just want to make sure that you're cool with that, because it won't be subsidized anymore. Usually companies subsidize that for the employee, sometimes for the employee and the spouse. So you want to be good. You want to know that you're good with what you're going to spend on health care until Medicare kicks in. That's number 1. Number 2 is if you're a big contributor to your 401k, the vast majority of times, severance payments are not eligible for 401k contributions. So you may have extra money in your pocket from this severance because you won't be contributing 10, 15, 20% into your 401k. And then the third thing that came to my mind was, is the severance going to be a lump sum, or are you going to get it every, say, 2 weeks like you got your paycheck? And the only reason I think about that is, if, for instance, you were going to get it in a lump sum, that would raise your taxable income in that year above what you're normally used to having as income, and consequently your tax bill will be higher. So, Richard, I don't think of a whole lot of things for downside for getting offered a severance package and moving on a year early. Those are the three things that came to my mind as things you'd want to consider if and when that actually comes to pass.
All good points on that one. And yeah, it's kind of funny when you hope to get laid off, but when the situation's right, the situation's right. So there you go, Richard. It's a great question. All right, let's get to our last one here, David, from Roger. And Roger says, should I set up a trust to help my kids save money on taxes when they inherit my investment accounts? Roger must have taxes on the mind here as we near tax date within another week.
Yeah. So, Roger, you've asked a really complex question, and I'm going to give you a reasonably simple, straightforward answer. And if I knew more about you, then we could get pretty complex with it. So, Roger, the starting point for me is, let's say that you're married. Unless you and your spouse total have an estate worth over $28 million, then there's not going to be any estate tax on what your kids inherit from you. Let's say you're not married, then this year it's $13.99 million that your kids can inherit from your estate, and there's not any estate taxes on that. If you live in Kansas or Missouri, there's no state estate tax. So if you do have more than $28 million, or if you're single, $13.99 million, then get some really good personalized advice, and maybe some sort of trust is a good thing. If you have kids that you don't trust with the money they're going to inherit, that's a really good reason to have a trust. If you have special needs kids, that's a really good reason to have a trust. I think there are some really good reasons to not have a trust. You save a lot on complexity. So, for instance, let's say you're a normal American. 99% of Americans, I Googled this morning, 99% of Americans are not going to have an estate tax problem because the vast majority of Americans don't have an estate of more than 28 million bucks. What you do get, what your heirs will get, is on your brokerage accounts. Let's say you have a brokerage account that's worth $1 million and it's got 10 different stocks in there, and they are they've grown. You paid $250,000 for them, and now they're worth $1 million. $750,000 a gain that you don't want to pay taxes on. The good news for your heirs is they're going to receive a stepped up cost basis on that non-IRA account. So they're not going to go any taxes on all of that gain that you've been watching accumulate for 5, 10, 15, 20 years. So that's good news for your non-IRA accounts. If you own some annuities, well, your heirs are going to owe tax on the interest that those contracts have earned over the years that you have never removed from the contract. So annuities grow tax deferred, but somebody eventually is going to pay tax on those earnings. That's not an inheritance tax. It's just an income tax, and that interest is taxed as ordinary income, so at the highest marginal rate. If your kids are in a higher tax bracket than you, then there may be some estate planning things you'd want to do before you die that would help Uncle Sam get less and your heirs get more. Then on your IRAs, 403Bs, 401Ks, any type of retirement account, every penny that comes out of that, it's not subject to estate tax, but it's certainly going to be subject to income tax for the people that inherit that money. And there's no escape from that, Roger. All IRA withdrawals, 401k, 403b, 457, I throw them all in the IRA category. All of those withdrawals, every penny of them are taxed as ordinary income. No capital gains, favorable treatment, none of that, and there's no escape from that. Will they have to take required distributions? Because there's a 10-year rule now on when you inherit an IRA, whether or not you have to take money out over 10 years or whether you can wait 10 years. But you can't wait 11 years if you're the beneficiary. That has to be cleaned out within 10 years. So there's a kind of some wonky rules there that you'll want to figure out that I'm not going to go into here. But then with your heirs, they'll want to get some pretty good advice, because even though there won't be estate taxes when they inherit it, there will be income tax when they take the money out. And let's just say that one of your heirs is 62 and they're planning to retire at 65. From a tax standpoint only, and this is not specific tax advice for them, but from a tax standpoint only, they will benefit, because it's very likely that while they're working, they're in a higher tax bracket than they're going to be in when they retire. So they would want to take less money out of the IRAs they inherit from you when they're working, because they're going to be at a higher tax bracket. Once they retire, that's a good time from a tax standpoint to start harvesting money out of those inherited IRAs, because they're going to be in a lower tax bracket. Once they turn, let's say they're going to turn their Social Security on at 70 and their required distributions start at 73. Well, once they turn 73, they're going to be in a permanently higher tax bracket. Almost certainly they are, depending on how well they've saved for themselves. But there are tax implications for your heirs that have nothing to do with inheritance tax, but they'd want to get some good advice on that too. So there's some certain things you could do, assuming you're in a lower tax bracket than your heirs, but you very likely aren't worried about estate taxes. Less than 1% of Americans are, because there's currently just under a $14 million exemption for individuals and a $28 million exemption for married couples. Roger, so I think I've prefaced this by saying I was going to make it a short and direct answer. Anybody that listens to this podcast knows sometimes I have a difficult time doing that. But hopefully there was something in there that you can use to say, I'm a really good do-it-yourselfer. I know what to do now, or I need to go get some professional help. And if that's the case, if you happen to be in our area, we'd love to talk to you about that. If not, go find a fiduciary that can give you some really good, unbiased advice and get you set up for whatever those concerns are that you have for the assets that you've accumulated that are going to be inherited by the people you care most about. Roger, good luck on that.
Another great question. Thanks, Roger, for submitting that one to us. And great answers across the board today, David. I think some helpful guidance for all three of these question askers. Maybe you've got a similar question on your mind, or it's from a different area of the financial planning realm. Well, no worries. All of that's covered in the complete planning review that David walks clients through. It's the CPR process, taking a look at where you are now, where you want to go into the future, into retirement, and considering all the different moving parts that are going to come at you and the different obstacles and the different things that we want to make sure we either take advantage of or avoid or plan for more generally in our financial lives. That's all covered in the planning process. And usually it starts with a simple question like we've heard on today's show. So wherever your starting point is, don't hesitate to reach out and have a conversation with David about those things. You can get in touch very easily by going to coveryourassetskc.com or by calling 913-317-1414. And again, contact info's in the description of today's show to make things easy on you. David, thanks for the great advice today, and we'll look forward to chatting with you again soon.
I'll look forward to that as well, Walter. Thanks.
All right, take care, everybody, and we'll see you next time right back here on Cover Your Assets, KC.
Creative One Advisors Group has been proudly serving families in the Kansas City metropolitan area since 2003. Over the years, we've evolved to help meet the needs of our clients, becoming KC Financial Advisors in 2010. In November 2021, our advisory business was acquired by Creative One Wealth LLC, C1W, and in January 2025, we officially adopted the name Creative One Advisors Group. Previous episodes were recorded under the branding of KC Financial Advisors, which has since been rebranded as Creative One Advisors Group. Any references to KC Financial Advisors should now be understood as referring to Creative One Advisors Group. Investment advisory services are offered through Creative One Wealth LLC, a registered investment advisor. Creative One Advisors Group is a DBA of Creative One Wealth. Insurance services are offered through licensed insurance professionals. Investment advisory services are provided in accordance with the fiduciary duty of care and loyalty that includes putting your interest first and disclosing conflicts. Insurance services have a best interest standard, which requires recommendations to be in your best interest. Creative One Wealth is not affiliated with or endorsed by any government agency and does not provide tax, legal, or estate planning advice or services. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against loss. Neither asset allocation nor diversification can ensure a profit or guarantee against losses. None of the information contained herein shall constitute an offer to sell or solicit any offer to buy a security or any insurance product. Insurance product guarantees are backed by the financial strength and claims paying ability of the issuing company. The Creative One family of companies includes Creative One Wealth LLC, a registered investment advisor, Creative One Securities LLC, member FINRA SIPC, and a registered investment advisor, and Creative One Marketing LLC. These companies share common ownership. Additional details regarding advisory services are available in our firm's ADV Part 2A and Form CRS.